everybody. Welcome back to the Economic Analyst channel. So this Consumer Price Index came out yesterday for the month of April, and it showed a striking change. So the year-over-year annual growth in the CPI actually dropped from a height of 8.6% on a seasonally adjusted basis in March down to 8.2% in April. This was akin to a 0.3% month-over-month change, which was a huge drop from last month's 1.4%, I believe. Let me check the record on that. Yeah, 1.2%. So consumer prices jumped 1.2% in March. They jumped only 0.3% in April, and then due to base effects of rolling off of March 2021 data and April 2021 data, that kind of dropped the annual growth rate of price inflation. I was expecting a 9.1% annual rate increase, which would have been akin to a 0.9% month over month. And I'll go over into a few details on why I think my model missed on that. When we take a look at core price inflation did much the same. It also dropped from 6.4 to 6.1. Core inflation actually came out higher than the aggregate at 0.6, suggesting that the structure of price inflation hasn't really changed all that much. But since price inflation jumped back in April of 2021 by 0.9% on the core basis, that rolling off still dropped the annual inflation rate. As far as market reactions to this, it was a mixed bag. So let me pull up the Dow Jones right quick if I can. The Dow Jones dropped, and it's over the last 5 days, it's dropped over 1,000 points, but in the last 2 days, it's dropped by about a net 400 points on the Dow Jones. That would be equivalent to about a 1.3% drop. We saw that in other indices as well. Also, something that's been interesting is that gold and silver drops. So they didn't really react very warmly to the news here of price inflation, probably because investors are betting on a stronger dollar. So the treasury rates have dropped, the dollar index has increased, so money is piling into more liquid investments that is believed to be a safe haven instead of the hard physical assets, because the narrative is still there that price inflation is transitory. So there's a sort of a hope, and what I believe is a very misguided hope, that this is peak inflation. So that's what I'm going to go over in this, is that whether we are really going to see peak inflation or not in this coming month. So once we take a look at the change by category, we see here that food jumped by 0.9% in the month. And this has pretty much been the trend that we have been seeing for the past 2 months. So for the past 2 months, for 3 months, we were seeing 1% changes in food. And also, when we take a look at core price inflation was the highest that it has been month over month in the last 3 months. So it was 0.5% from January to February, dropped to 0.3% from February to March, rising up to 0.6%. Shelter component is staying steady at 0.5%, which is a major portion of this core price inflation. And we're seeing a huge jump in airline fares, and which is pushing up the aggregation of transportation services here. And although used car prices dropped by a little bit, new car prices offset that. So core inflation still pretty high there. And I think that kind of derailed consumer sentiments, because there was the expectation that we would be seeing hopefully a lull in core price inflation as well, and didn't get quite as much of a lull in that in the aggregate as what investors were hoping for, which may explain why the stock dropped downward. Nevertheless, we did see a low of a 0.3% on the aggregate. That's much lower than the 1.2 from February to March and the 0.8 in January to February. Well, what happened? Well, it was energy prices, and it was caused by a drop in oil and gasoline. So what happened there? Well, I believe the reason why my model missed on this is that this surprise energy drop was caused by the U.S. federal government releasing some of its strategic oil reserves out into the aggregate market, which has temporarily depressed gas prices. But if we pull up what gas prices are going on right now, and take a look at that gas trend. So we're going to go to EIA.gov. we can see that in the past few weeks, we can see how gas prices have been trending up throughout. After bottoming out in the middle of April, they've been trending upward in May. And so this increase here is showing about a 7 to 8% increase in gas prices, which more than offsets this 6.1% drop that we saw from March to April. So more than likely, and I would venture to say, we're going to see energy prices rise, and we'll probably see them rise by about 0.3 or 0.4%, much like we saw in January to February. Had we not had this drop in energy prices, then my CPI index would have come out at 0.6%, which would have still been underneath the model performance. But had we had a 3% increase in energy prices, then my month-over-month change rate would have been 0.8%. And that would have been much closer to what the model was forecasting in month-over-month changes. So I think it missed because of that move by the federal government to temporarily increase the supply of oil and energy consumption available inside the markets. And it probably will not miss going forward, and we'll probably get some of that revenge inflation. So in other words, this CPI will more than likely bounce back. When we take a look at the price formulation index, I have created a business expense index, which all it is an average of the producer price index by commodity and the median wage paid out. This chart is in blue. The actual CPI is in orange. You can see how there's this strong correlation between the two. It's very, very powerful, much like final demand and the CPI are tied together for the last 10 years. And the business expense index is actually running ahead of the CPI, driven by higher and higher commodity prices. This is strongly pointing toward more and more price inflation happening in the CPI. And extrapolating out the producer price index increases and the wage increases for the year, this business expense index is looking like it's going to push over 14% annual price inflation by the end of this year. And if that relates to the CPI, then we're looking at a CPI price inflation ending around 12% by the end of this year. So much contrary to the narrative that has formed that we're seeing peak inflation. On the contrary, we're probably going to see inflation pick up. And the reason why is because the producer price index has been increasing month over month, year to date, by 2% or more. And that's translating out into a 25 to 30% increase in the producer price index year over year by the end of this year if it continues on that trend. Factor in that wages are set to increase, according to a CNBC survey, by 3.4% this year, which is, pretty modest increase from the 2.8% in 2021. Average the two indices together and you get the business expense index, and it's certainly pointing to the 14, maybe 14.5% year over year change. And seeing how the CPI is lagging behind it a little bit, we'll probably get about a 12% change in the CPI at the end of the year. So unless if we start seeing a cooling off in the producer price index, we're probably not going to see a cooling off in the CPI. So by the end of quarter two, I expect that the CPI year over year change, hold on one second, let me get to this, will increase up to about 9% by the end of June, okay? So 9% annualized price inflation by the end of June. And then by the end of September, we will probably see it hit around, say, 12%. And hold on one second, about 10.5%, and then touch off at about 12% by the end of the year. So definitely not looking good for the inflation indices, and that's just because we're seeing costs go up on both the wage front and the input costs for commodities. So that's really been the driver there. When we back out and take a look at the money growth that has been going on inside of this, and hold on one second, let me see if I can't pull up that chart of money growth right quick. There it is. I've created a price regression index, okay? So what I've done is taken the money supply growth rate, factored in quantity goods available per year, and then factored in the dollar index ran a linear regression analysis, and that's this gray line here. The blue line is a price formulation index I created just using the money supply and quantity goods created. And you can see that after COVID, we started seeing huge increases in both indices, suggesting that we're going to see an upward, continuously strong upward swing in the consumer price index. What's particular that I want you to pay attention to is that for the past 10 years, this gray line, this price regression index, has run very closely with the consumer price index. And when COVID hit, there was a huge divergence as the influx of new money has severely pushed up this price regression index, suggesting that if we're going to see a reconvergence of the two lines, then we're looking at a minimum of a 20% jump in the consumer price index just to catch up to the trend line of the price regression index. Now, this doesn't mean that we will see that jump. For example, in the 1970s, the price regression index ran ahead of the consumer price index for some time, for years. But even if the two were to trend together, it's definitely still pointing to strong upward consumer prices. And when we look at the business expense index, it looks like we're going to see consumer prices go over 10% by the end of this year, pushing 12. I just don't, until I see the producer price indices cool down on the commodities front, we're just not going to get that cooling down in the consumer price front. And I would venture to say that the 3.4% projected wage increases is probably going to be on the low end. I would expect that businesses will have to mark up wages by more than 3.4%, which could even push price inflation up even further if the trends hold through, much as they have had in the past. So again, just to recap, there's a strong correlation between the CPI and what I call the BEI, or business expense index, definitely pointing to price inflation building and continuing. We'll probably reach the peak, the previous peak of 8.6% next month, if not surpass it, and push up from there. So by the end of this quarter, we'll reach 9%, then 10.5% by the end of September, and then by the end of the fourth quarter, push up to 12%. Next up, the next analysis I'll put out for you is going to be over the producer price index. I know that the numbers came today. I'm still digesting that. I'll feed that into the producer price index final demand model. That'll give us a better idea of what to expect of price inflation to push forward. But more than likely, I expect it to coincide with this business expense index. So if I were to take a look at the average of the year-over-year increase in the CPI of what it's been projecting, the CPI right now at the end of the quarter was 8%. So it made sense that for April, we would see the CPI be at about 8.3 to 8.4%, then push up to about 8.6 to 8.7 in May. So that's where I expect we would be at the end of May, and then finally push up to 9% at the end of June. Guys, I hope you like the content that I provide for you. If you like this video, if you like what I've the data and information that I'm providing for you, just show me some support. Click that like button, drop me a comment, let me know what you think about all this. Subscribe to my channel if you haven't already. And as always, click that notification bell so you'll be notified whenever I do upload a new video. Tomorrow, I will probably upload my producer price index analysis on that, and that'll give us some more details on what to expect on the inflation front. Once again, guys, I thank you for watching this video, and I'll talk to you next time.